Commodities are in the headlines for all the wrong reasons at the moment. Joining me today to share his insight on oil is Colin Smith, Head of Energy Research at VTB Capital. Now Colin, we have heard all but two members of OPEC have agreed to abide by the 30 million barrel a day oil production rating ceiling. Do you think these so-called allocations are sufficient to provide balance back to the market?
I think OPEC setting 30 million barrels a day back in December was a reasonable stab at the number required to balance the market. But the lack of individual quota allocation always made it very unlikely to be met in the context in which I think Saudi Arabia has been keen to get the price back to the $100 a barrel level. I think the meeting in OPEC makes absolutely no difference to that, and in fact therefore it will be down to whether and when Saudi Arabia decides to cut output. That will be the start of the process of recovering oil prices.
The EU's embargo will mean in less than 2 weeks Iran's biggest oil customers will lose access to European insurers. Given that Japan have already secured Parliament approval allowing the government to provide insurance cover and China is asking Iran to take on the risk, what impetus do you think these sanctions really have and what effect do you think they will have on the markets?
I think it rather depends what angle you're looking for here. If the bigger question around oil is whether or not the incremental US sanctions and the EU embargo from the 1st of July will actually make much of a difference to Iran's volumetric supply to the market. And my view is that it will have relatively little impact, although I do think that Iran is struggling to maintain existing production levels because of the sanctions pressure that it is already under. I think the idea that tanker problems would be a significant impact on that supply ability of Iran was always a red herring, because when push came to shove, there's enough tanker capacity either out there or that we would have happening what is happening, which is that countries that want to continue to import Iranian crude will put alternative insurance provision in place to enable tankers to continue to deliver oil to them. As far as Europe is concerned, the European embargo is part and parcel of trying to increase the sanctions pressure on Iran, and therefore it's not really, I think, a sort of a practical measure about whether they should take it off because others are not doing it. I think it's a matter of principle as far as the EU is concerned. But broadly speaking, I think the incremental sanctions will have relatively limited effect. And I think the fact that the US has now granted a significant reduction waivers to all major importers of Iranian crude, with the exception of China, effectively emasculates those sanctions. And I think there is a fairly high chance that the US will proceed to give such a waiver to China before we get to the 28th of June, when the new sanctions would become applicable.
Today oil dropped to the lowest price in 8 months in New York after US stockpiles unexpectedly increased and reports signalled China's manufacturing will shrink this month. China has been described by some as a cornerstone of global oil demand over the last couple of years, but what would you attribute to this huge drop in price?
I think obviously a lot of the tone about why oil prices have been coming under pressure is to do with concern about demand, and specifically with developments in China and to some extent with softness in the US. I think the reality is that the pressure on oil price has been much more supply-driven rather than demand-driven. And I think if you actually look at demand forecasts, they've actually been pretty stable over the last few months, and I don't really expect that to change very much. So I think the weakness that we're getting in the oil price at the moment is largely, as I say, driven by the supply side. And I think that's largely driven by the fact that OPEC is supplying crude in excess of the call, as we expected that it would. And that is a feature of Saudi Arabia effectively maintaining production at around 10 million barrels a day, as production capacity and production has increased within other members of OPEC, notably Libya and Iraq.
Some analysts have suggested if oil falls below $80, OPEC may start to murmur about revising production quotas. What do you think will be the most crucial course of action in getting oil back to a competitive price?
I think the current discussion around the existing quota is a red herring. In terms of bringing volume off the market, the first issue is really going to be, when does Saudi Arabia take the volume off the market? And if it does agree to do that, is whatever it takes off going to be sufficient, or will there have to be a full-scale discussion among OPEC members with clear allocation of quota responsibilities. I think if that were to become necessary, it would ultimately happen. But the key here is not just the number, it's whether or not there's a clear process by which volume comes off the market. And if that is to be a broad-based OPEC process, then it needs individual clear quota levels. I don't think it's so much the 30 million barrels a day that's a problem. If we look at the call on OPEC crude for the second half, that could easily be 31 million barrels a day. It's the fact that OPEC is already producing well over that level and needs to cut back from that level if it wants to recover the price. I think the answer is that Saudi Arabia is there to defend $100 a barrel, and I would expect it to make the first move.
And finally, what do you think the future has in store for oil?
Well, I mean, our basic view on oil is that at the moment, supply is exceeding demand, and until that stops, the price pressure will sit to the downside. I think there is a bit of an issue in that clearly there is the possibility that new sanctions and pressure on Iran do in fact reduce Iranian volumes significantly in the second half of the year, and I think that may be causing Saudi in particular to maintain current production levels for longer than it otherwise would do, and that obviously raises the potential downside risk in markets as we go forward. However, at the end of the day, I think the $100 a barrel they've identified is a number they're serious about defending, and I think in the round within Saudi Arabia and indeed within the rest of OPEC, there is both the intent and the capacity to remove sufficient volume to recover the price towards that sort of level. In the very short term, there's certainly downside risk. I think the signal to the start of the process in which that downside is removed and ultimately the price improves will be as and when Saudi indicates that it is going to take volume off the market and does so.
Colin, thank you for joining me. That's all we have time for at the moment, but click back to Dukascopy for hourly market updates throughout the day. Goodbye.